As the markets are currently assigning a 60% chance of an emergency rate cut, this is what Tom Lee just said on CNBC today.
Bring in Tom Lee, Managing Partner, Head of Research at Fundstrat Global Advisors, as well as a CNBC contributor. In times like this in the past, it always would help to know, Tom, whether it's a sharp, scary spike down, which a lot of times the other side looks just like it, or people are hoping for that so much that they don't see that it might have longer to go. Do you get the feeling that this is not going to be a major sell-off?
For now, I think it is the former that you described. You know, we have over 3 days, suddenly markets reverse and, you know, Japan down over 20%. And as you're pointing out, the NASDAQ could even, you know, decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, you know, meaning like, do markets seize up? But with interest rates falling, you know, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that
it's a
today's
growth
the bottom.
Scare.
Yes.
It's kind of interesting that it almost looks like the market's doing what the Fed didn't do again. It's almost like once again they're there, but not really ahead of what's happening, and they're reacting, not anticipating, kind of again.
Yes.
On the way up and on the way down.
Yeah, the 2 years is signaling that the Fed is behind because 2-year yields have fallen further. But it does seem like, as we look back a lot more, this is because of the surprise hike from Japan and the sort of knock-on effects from there. If that is the primary source of the reaction, I know it's going to be tumultuous for markets, but for the U.S. economy, it's not necessarily bad news. And I think that's why we can balance.
Some of your great and accurate calls have been based on inflation coming in like you thought, much cooler than the market was thinking at the time. I guess the flip side of that is that there can be the dual mandate, there can be labor market weakness associated with why that's happening. Was the asymmetric risk, maybe it wasn't asymmetric, maybe there was a great risk to the job market?
Well, you know, markets don't like surprise. I mean, Friday's jobs report was disappointing.
How far back did they go with revisions down, too? It almost looked like the whole story, the whole narrative that we had is suspect about
That's right. And I think many expected that because, you know, the establishment survey versus household had so many gaps. And so that's kind of converging. But that means markets are waiting until August payrolls report, which is not for 4 more weeks, to really know. But I would say, to me, it still seems like July, even as bad a report it was, is more of an aberration. And I think the trend is still...
Weather, there's a couple of things in it that people...
Yeah, there was almost a record number of people that were having temporary layoffs and people who weren't working due to bad weather. And Texas had a big spike in jobless claims. So it does look like the hurricane had some effect, although the BLS said there was no effect.
On Thursday night, one of the people at your shop said 53.90 looks like a good S&P support. Do support levels mean anything? And you want to give me another one, or is it just another one to go through?
Well, you know, because it didn't hold, it means that there are other support levels that could be important.
It might not hold.
Yeah, it could not. I think that the VIX is telling us that.
We got to watch the VIX.
Yeah, because it spiked Friday and then it's spiking again today. I mean, the last time the VIX was at this level was April 2020. So for an investor, that tells us kind of where we are, which is we know markets are nervous and they have to unwind, but it's not been a bad time to be thinking that there is a big opportunity on the other side, because once the VIX starts to calm down and markets have already corrected, we know that there's opportunity.
Right. I mean,
knowing that, of course, it's August, as you point out.
You think the VIX high 40s is where it's going to peak, or low 50s? I guess, it's up 100% almost.
Yeah. The VIX may not have a ceiling because we know next couple of days there's also some geopolitical events on the horizon.
And Israel,
Yeah.
and Iran, and we got politics here.
I mean, that's escalating. Some people think, well, that's going to turn into a nightmare this
Supposedly
week.
today, or
right.
tomorrow. I mean, we don't want to.
So I think that's why it's all coming to a head this week. I mean, to me, it's a very important week because we know it's hard to catch a falling knife, as you're pointing out. Support levels are being broken, but mortgage rates are falling. The consumer's in pretty good shape, and the job market. I think it's very unlikely.
But so if the knife is falling, and you like catching falling knives, I know you. So the question is, at what point do you catch said knife?
I spent a lot of time talking to Mark Newton, our technical strategist, over the weekend, and I think that there is a reprieve coming this week. Like, who knows? It could even be today, right? We could open down huge, and then after 11 a.m., we could reverse higher. But I kind of agree with Joe that this is still August, and I think that markets traction really doesn't come back till October. So between now and October, it's maybe a range-bound market at best, but there'll still be opportunities.
And we could call it Bitvidia, basically. I mean, it might as well be. Bitcoin, what is Bitcoin? Gold's hitting new highs, Bitcoin. Yields, people look for safety. They buy treasuries, they buy gold. People don't buy Bitcoin for safety.
Yeah, Bitcoin is still mostly a risk-on asset. And, there's potentially been lots of liquidations. I think several 100,000 accounts liquidated over the weekend.
This Insight, which is Fundstrat, cites Tom Lee's message out today that says equities suffer technical damage, which takes time, but consistent with tough August. Second half of 2024 still expected to gain strongly, led by small caps. So what's going on right now in markets, just so everyone understands, it is a Japanese carry trade that is imploding the world. Okay, global financial markets are imploding. This is the worst day since Black Monday for the Japanese stock market, and this is a rough day for US equities as well. Now, what a carry trade is like arbitrage. Japanese retail investors, corporations, the government, big money investors over in Japan, they've been borrowing money in Japan with very low rates and investing that money in foreign markets. Now that the Japanese central bank is starting to raise rates, Japanese investors don't like that. What's happened is you're seeing this liquidation globally because of all of this money that is invested globally with a central issue that's going on in Japan. So the carryover trade is like $20 trillion. There can be more selling. It's a real possibility. There's also a potential this could lead to Jerome Powell needing to do an emergency cut. Think about it like this. The Bank of Japan, they're starting to begin the process of raising rates, but we're still offering a really high rate compared to Japan. If the Fed does come out and takes a decisive action to lower rates, that could smoothen out the carry trade a little bit and potentially give the markets more stability. Although if the Fed comes out and cuts rates, that's probably not going to be good for markets in the short term. We also have this Iran-Israel conflict that could be having some role to play in markets as well. I wouldn't be surprised if when that actual attack does happen against Israel, markets may look at that as a buy the dip opportunity because, the catalyst is over at that point. But really, like 95% of this global meltdown is directly related to Japan. And just to kind of show you how much fear there is out there, the Kobeissi letter on X says the volatility index, the VIX, is now trading above 65. This was in the beginning of the trading day, a level only seen two previous times in history, the 2020 pandemic and the 2008 financial crisis. The VIX is up 550% from its July 2024 lows. That is a wipeout of $5 trillion of market cap value in the S&P over the last month. I will say for the bulls out there, the S&P is almost oversold on the RSI. Every time you get down to this level, you do get a short-term bounce, okay? The S&P really doesn't go overbought for an or oversold for an extended period in time. The Rona, you were overbought for a period, so it is possible, or oversold for a period. So it is possible that you could go oversold, but historically you tend to bottom when the RSI hits about 30. Good news for the bulls. Today the RSI is at 31.28. So you're basically at that level in which you should start to expect a bounce. Even if we don't get one, I think it's best to probably start to expect one. Just based on kind of the historical precedents around that 30 level on the RSI. Now, I think the bigger question is, after a bounce, does this lead to lower levels? And that's a good argument. Because historically, when the Fed cuts rates, that's not good for markets. When the economy weakens, that's not good for markets. And that's the direction that we are headed in. Liz Young Thomas, she is the head of investment strategy at SoFi, one of the only stocks that is green today, a matter of fact. She says the 2s and 10s uninverted. Yes, that briefly happened today. You are back inverted 11 basis points, but at one point you were briefly uninverted. The VIX spiked to 65. Things move fast. Lots of chatter about an emergency rate cut. Can't know yet if this is a short-term blow-up or the beginning of something bigger and longer. In the meantime, fear begets fear, and a cut doesn't, quote, fix it. Which I think is the best take on this situation. We don't know if this was just a, flash crash, if you will, or if this is something that could be bigger and longer drawn out, like 2022. And I think that really comes down to the economy, this unwind trade, this carry trade, that's unwinding currently with Japan. It will end at some point. Now, does that ending lead to the markets rebounding? That's the real question. And I don't have a good answer. I'm still defensive, kind of bearish on this market over the medium term because the economy is weakening. That's the bottom line. But would I be loading up on puts right now after the drop that we've seen today? Probably not. Treasury yields hit a new 52-week low today, but now they're not actually moving at all. You're basically unchanged for your 10-year Treasury yields. They were down a lot more earlier in the trading day, but 10-year Treasury yields are sitting at 3.78%. So yields have just completely plummeted. The percent of stocks currently trading above their 50-day moving average is getting absolutely destroyed today as well, down 22%. So to put this in simpler terms, 11% of all stocks today are breaking below their 50-day moving average. That is after, you have fallen big time for 3 days in a row. Okay, you went from about 75% of stocks trading above their 50-day moving average to 38% of stocks trading above their 50-day moving average in a very short amount of time. Does that mean you're going to bounce soon? Not necessarily in and of itself, but there is a lot of pain out there. And normally when you get down to these levels in the 30s, you do tend to see a bounce in markets. Keep in mind what I'm saying. I'm pretty bearish on markets generally speaking, and I still think there can be a bounce here. And likely will be a bounce here. Wouldn't surprise me if tomorrow's a positive day for markets. So you gotta be nimble in this market. You got to be in and out of positions. I think there's going to be a lot of volatility back and forth. The trend definitely looks like it's downwards, but the velocity of this move is so strong that investors are going to look around and say, are things really as bad as the markets are suggesting they are? And I don't think the economic data is bad enough just yet to draw that conclusion. This ultimately boils down to the economic data. Now, if the Fed does an emergency cut, then obviously that's going to take precedence and markets will sell off because of that. Because why is the Fed cutting? Do we have a bigger problem on our hands? That's the kind of mentality you get around Fed cuts, especially emergency Fed cuts. That doesn't happen almost ever. I do think the selling is a little extreme here in the near term. There's what we've seen over the near term. There's obviously the Japan carryover trade that is directly causing that. So there can be more of an unwind. But I do think the buy the dip mentality appetite out there is still strong under the surface. And let's be honest, Nvidia's down 6% today for that matter. It's trading at $100 per share. I think a lot of institutions would love to buy Nvidia at $100 per share. Like, how much more selling are you going to see there until the economy weakens or the AI cycle shows that it's slowing down, that it's not just straight up and, vertical? I mean, these are valid arguments. With that said, you did bounce quite a bit today, though. At one point in pre-market, you were getting pretty close to a circuit breaker on the NASDAQ. Even on the S&P, you hit a low of about $507 for the SPY. Now you're at $519. So you've seen a little bit of that bounce, even though the S&P is still down about 2.5% at the time of recording this video. It's still a rough day, but it was a lot worse. CNN's fear and greed indicator is in extreme fear territory, sitting at 20 yesterday, or I should say Friday, you were at 27. This was down in the 15, 16 area at one point today. So it's improved a little bit, but still lots of fear out there. Market momentum, extreme fear. Stock price strength is greed. Stock price breadth is fear. Put and call options, extreme fear. Market volatility, extreme fear. Safe haven demand, extreme fear. And junk bond demand, also an extreme fear. Ed Goolsbee says today, if the economy deteriorates, the Fed will fix it. Like it's just that simple. Fed Goolsbee says the Fed will respond to conditions. And Fed Goolsbee says when asked about an emergency cut, quote, everything is always on the table, including raises and cuts. So he did not explicitly say a emergency Fed cut is coming. I wouldn't expect that, but he didn't deny it either. That's part of the reason the markets are assigning about a 60% chance of an emergency Fed rate cut coming as soon as this week. It's also being reported today that Nvidia and Taiwan Semiconductor Manufacturing are facing production challenges with the next generation of its AI chips, according to Financial Times, and this can also be having a broader impact on Nvidia, and Nvidia has a broader impact on the markets. So again, let me know what you think about this information down below in the comment section. But all in all, I do think a bounce to that 100-day moving average on the SPY would make a lot of sense here. That's around $528 per share. This line I have had drawn here on the chart for a very long time is also important. Looks like you're getting a lot of resistance around that 520 level. I think if we can retake that 520 level today or tomorrow, that would obviously be seen as positive, constructive on a technical basis for the S&P. I think time will tell. This Iran-Israel situation is going to be the next thing markets react to. This continued kind of carryover trade that is unwinding. I think it's going to take some time. You're seeing people getting blown up out there. We don't know how much damage has been done yet. And that's the other side to this coin. But ultimately, I think the economic data is most important. And that's what I want to personally react to. Okay, that's what I believe justifies a potential 30, 40+% decline. But all of this other stuff, it's short term, it's short lived. And I think the selling has, been extreme for some short lived, short term events. So from that perspective, let me know your thoughts on our markets. Do you think we're going higher or lower? I would love your perspectives down below in the comment section. Nonetheless, hit the like button as well as subscribe to the channel if you have not done so already. And if you made it to the end of this video, you guys enjoy the rest of your day, and I will see you in the next one.